another week of records on the stock market, as nothing seems to slow the bull market's momentum. The S&P 500 closed above 5,000 for the first time ever. The Nasdaq is close to its 2021 highs, and again, there seems to be no slowing the inertia and momentum of what we're seeing in the stock market so far in 2024. We're in the midst of earnings season, and earnings is one thing that could shake the market's momentum, but it hasn't, at least not on a macro level. That said, there have been plenty of companies whose stocks have either soared or plummeted in response to their earnings results. I always like to look at these events to see what the market missed, what I may have missed, and what we can learn from these big moves. So today, we're going to talk about two companies whose stocks sold off after earnings last week to see what we can learn about those companies, about the stories their stocks were telling, and about what that means for us as investors as a whole. My name is Daniel. This is the long and the short of the market. You can get this every Monday on this YouTube channel by subscribing. You can check out middlecoastinvesting.com for text versions of this. So click, subscribe, and let's get into today's topic. The first company we're talking about today is PayPal, a payments company. It's a technology company that was founded in 1998. It went public in 2002, was bought by eBay that same year, and spun back out to public markets in 2015. It is now an independent company. You're familiar with PayPal from checkouts, from using PayPal in different forms online for sending payments to friends or businesses. You may be familiar with some of PayPal's other brands, such as Zoom with an X, which facilitates currency transfers, Venmo, which is person-to-person payments, or Braintree, which is a major processor of credit card payments online across the web. PayPal also owns a few other brands and businesses underneath that, but everything geared towards facilitating payments, especially online, though increasingly through the phone in real business situations, real physical world situations. Taken from one perspective, PayPal's business is a very successful one. Since 2017, its revenue has grown 14.3% a year, and its earnings per share has grown 17.4% per year, both very impressive numbers. Taken from another perspective, PayPal is stuck. The company has not seen major growth since the pandemic and exemplifies the boom-bust dynamic of the COVID pandemic. So many companies benefited when everybody had to go online to do everything, including shopping, and everybody in e-commerce seemed to benefit from this, PayPal among them. PayPal's shares, revenue, and earnings all soared in 2020 and 2021, and at its peak, PayPal's shares traded for $300+ a share versus the $58.91 a share it closed at last Friday, a more than 80% drop. The same goes true for market cap, obviously. PayPal was worth $365 billion and is now worth about $63 billion. That's a huge come off. Why is that happening? Because PayPal's not doing any better than it was at the COVID peak. It hasn't been able to grow its profits in any way. Revenue is still going up, but PayPal is taking less and less of a chunk of the payments facilitated on its platform, and so it's not really getting any benefit from it as a business. Gross profit or transaction margin dollars is flat since 2020. Earnings per share is more or less flat. All of these profitability metrics aren't going anywhere. PayPal is dealing with a lot of competition, which is the other part of the COVID dynamic. As this market looked really big, a lot of companies muscled into it. You have Apple Pay, you have Google Pay, you have other payment-specific companies that have emerged, whether they're Adyen, which is more Europe-based, or whether they're Block, or many other companies that are all trying to fight for a piece of a transaction. I should say that I've never really been able to wrap my head around all of the dynamics of the payments industry, which is why I've never been interested in making an actual investment in PayPal, because there's a lot of jostling just to take a 0.02% or a 0.1% of each transaction. I didn't quite understand it. It's a tough competitive business, and PayPal is struggling to grow within that. PayPal's earnings were a big event, though. They came out last Wednesday. The company has been getting some buzz from investors as a potential bottom-ticking opportunity. This is the sort of investment I like to look at. A former tech darling that has sold off a lot, but still has a strong, growing in some form or another business at the end of the day. That's where you can potentially get real value now that the hype is worn off. The company also hired a new CEO, Alex Chris, formerly of Intuit, the company that produces QuickBooks and TurboTax and so on. And it would seem that they would have a new plan that might help them to reemerge. And PayPal seemed to meet the moment in their Q4 earnings. Its revenue beat estimates, its EPS beat estimates. And yet, shares sold off heavily that day, and in the 2 days after the earnings report, finished down nearly 7%. So what's going on? Earnings is a great opportunity to see what's priced into a stock. What do analysts, investors, observers expect the company to be doing at this point in time? Judging from everything I could read after PayPal's report, it looks like two major things were priced into the stock, but then didn't show up in the company's guidance and expectations for the year ahead. First was some form of growth. PayPal gave guidance for 2024 that showed no change in non-GAAP EPS, no change in GAAP EPS or no meaningful change, no change in transaction margin dollars, their gross profit off of which everything else could flow. It doesn't seem like PayPal is yet ready to return to its growth days. This would be fine if it was a one-off, but given that the company hasn't really grown since the pandemic peak, that is concerning. The second part of this is that investors might have expected to see some sign that the new CEO's plans were going to have an effect on the company and thus the stock. Chris rolled out 6 new initiatives a couple weeks before the earnings report for how PayPal was going to improve its checkout flow and other things. And actually, the stock dropped that day too, as investors were apparently underwhelmed. But evidently, they still thought that something might come out of this in terms of growth for the year ahead. An analyst asked more or less, when should we expect transaction margin profit dollars to improve? When should we start to expect growth to reaccelerate at PayPal? And the CEO, Alex Chris, said something to the tune of, I'd like to get some points on the board before I start building expectations around these new initiatives, which is appropriate conservatism perhaps, and an appropriate stance to take, but not what investors wanted to hear. Which leaves PayPal in an interesting spot. On the one hand, it's a reasonably valued company. It trades at 13 times more or less last year's free cash flow, or 18.5 times if you make some adjustments that the company asks you to add in and remove share-based compensation. It trades at 15.4 times GAAP earnings for last year, and thus for this year coming up, 9.4 times EV EBITDA. All of these different numbers are, I would say, either at average or the cheap side of average valuation. That sounds okay, but if the company is stuck and neutral and is not growing for another year, for a fourth consecutive year, then it may make sense that investors are starting to get a little antsy, and it's not so cheap as to make that an okay stance, that multiples would need to be less for no growth to be okay. Whether Chris is able to reaccelerate growth remains to be seen. The bullish spin on all of this, you could argue, is that expectations for growth have gone out the window for this year and perhaps for next. And given that, maybe there's going to be room for any positive surprise to really accelerate things. And given how strong PayPal is as a brand, if Chris and team can get the growth train on the tracks, there should be plenty of time to get on before missing out on a big move. That would be the spin, but that's where PayPal is left and why shares, in my view, may have sold off last week. Let's go to another story in a very different sort of company, Pepsi. Pepsi is a different story from PayPal for a number of reasons. There are the obvious ones. It's a consumer goods company that sells beverages, snack food, other types of food. It's a much older company, in theory, a much more mature and slower growing company, and actually a much more expensive stock. Pepsi has grown earnings by 6% the last 4 years per year, and revenue by 8%, which points to another thing that Pepsi has been caught up in, which is inflation. When revenue is growing faster than earnings, there's got to be something to explain it. Its costs have inflated, but so has its prices. Pepsi has made a lot of hay raising prices on customers. Last year, for example, Pepsi raised prices on average by 13%, more than outweighing its actual revenue growth as volume dropped off. What changed in its report is simpler to understand than PayPal. Pepsi had previously said that its guidance was the high end of 4 to 6% revenue growth for next year and high single digits earnings. And on this report, it said, actually, we're going to grow at least 4%, so the low end of its range, in organic revenue and at least 8% in earnings. The company argued that it didn't really change the earnings guidance, but it lowered the revenue guidance for a bunch of small factors. One of the things going on here, which will be well received, I think, is that Pepsi expects to have a more balanced mix between pricing and volume growth, meaning that it won't raise prices as much as it has in recent years. Talked about a normalization of cost and inflation. This is a good sign for the economy as a whole, that inflation is another evidence point that maybe inflation is getting under control. And I think for investors, it's more exciting when a company is able to grow volume in a profitable way, but when more people are willing to buy the product, that's probably a better sign than that the company can raise prices, at least for a mass market good like Pepsi. The Goldman Sachs analyst, writing in the immediate aftermath of the report, said something like, Pepsi is resetting expectations. We think investors are going to reset their expectations, and we would expect to sell off as a result, but this may be an interesting long-term entry point for Pepsi. The reset saw Pepsi shares sell off 3.5% Friday. Now, an earnings move can go for weeks, but you'll often see this intensified version of what we saw with PayPal, where it's 2 days. First, the immediate reaction from the market, and then all these sell-side analysts that are investment bank analysts following the company closely will give their updates, which will then tend to nudge the shares further in one direction or another. So maybe we'll see more of a move on Monday from Pepsi than we would a normal day. But either way, Pepsi, as it stands today, is trading at something like 20.6 times adjusted earnings guidance for next year and 33 times last year's free cash flow. It's not a cheap stock, especially for the growth that Pepsi's expecting. I talked about Professor Aswath Damodaran of NYU on last week's video, and I'll make it 2 weeks in a row. Professor Damodaran talks about how every valuation contains a story about a stock, a narrative to explain the expectations that the market, that is, all the participants trading stocks, investing in stocks, buying or selling stocks at a given price around the world, has for a given company. What the collective hive mind expects to happen for company X or company Y. There's a saying that journalists are writing the first draft of history. They take the events that are happening now, report on them as accurately as they can, so that we have an initial understanding of what's happening, knowing that we won't get the full story until later. In investing, those sell-side analysts I mentioned are filling that role, taking the first draft, taking the data from the companies and putting that into short-term hits that will explain what's happening with the company for the next few months or year. Sell-side analysts are talking to companies regularly so that they can align their models with the company's models, and they're talking to investors regularly so they know what questions they should be asking management. Earnings reports are often the best meat that they have to put together their story, to understand what's happening under the hood at a given company. Some sell-side analysts are quite good at what they do, and some are not as good, the same as in any profession. But what they're trying to do is to put these short-term events into a story that makes sense over, as I said, the next few to several months. Long-term investors have the opportunity to play something like the active historian in this story, giving a longer-term perspective and stitching together these short-term events into a wider tapestry, something that will matter for years, not just months. That said, it's valuable for us to understand those individual events because they will add up to the broader story. We want to understand not only what's happening in this quarter, but what other investors or traders are thinking about the story and what they care about, and what might cause companies to move in one direction or another in a given report. That'll help us better understand whether this story is one that we want to stick with for the long haul, because there will be moves that surprise us, or there will be events that we did expect and that are less scary because of it. Pepsi's story, based on their latest report, doesn't seem to me like a major change. A minor tweak to guidance, yes, it'll require some adjusting, but it doesn't fundamentally change the story for Pepsi, which, as I understand it, is that this is a solid leader in snack food as well as beverages that should expect to grow at a predictable level, and the market likes to pay higher prices for predictability. Pepsi's got it. It was able to raise prices in a tough time. It should be able to grow volume again. We're always going to want junk food, soda, and so on. Pepsi should be safe in most scenarios. That's the story. I should say I own shares in Pepsi, but only because I'm managing an account that already had shares. I don't yet have a super strong opinion about the company. In PayPal's case, the story was going to be new CEO kickstarts growth with a bunch of new initiatives and gets everybody excited for the possibility at a leading payments brand. Instead, the story is more like, let's see what's going to happen. The dreaded phrase transition year came out in a lot of reporting about PayPal's Q4 report. Markets hate uncertainty, hate transition years, hate waiting. This is a tough spot, and so all attention will be paid to whether PayPal can get out of this transition successfully and start growing again. Now, for the long-term investor, that could or couldn't be an opportunity. It's worth remembering that on the one hand, zeroing in on when a transition is a positive one can lead to big upside. Sometimes the first draft focused analysts and investors miss the broader picture and miss out on what will seem obvious in hindsight. That's the story with Meta in November 2022, with Netflix in April 2022, and with many other cases. At the same time, they're not idiots. These short-term analysts are skeptical because they've seen this story before. They've seen this pattern play out, and they understand that it doesn't lead to good things for a lot of companies, which makes them more skeptical that it'll lead to something good for a company like PayPal. That's the balance that investors are playing out in this earnings report and in a lot of earnings reports. It's a balance of understanding whether the latest twist means that the book is worth closing and putting away, or whether it's worth sticking through to the last page because the ending will be rewarding. That's all I've got for this week of Long and Short of the Markets. Subscribe to this channel on YouTube if you're enjoying this. Share it with a friend. Check out middlecoastinvesting.com for text versions of this and a lot of other stuff. Thank you again for watching. My name is Daniel, and I will see you next time.